Hey everyone, it's inflation day today, right? So we just had the CPI come out. Inflation expectations were slightly lower, 8%, 8.3% versus estimate of 8%. What does this all mean? I mean, the bottom line is that obviously the objective of the government and the Fed is to drive inflation lower. Inflation is very sticky. Food prices was one of the big components that kept inflation higher. New cars also, used cars going lower. So what does this all mean? I mean, it means that the government, the government and the Fed are trying their best, but inflation is very sticky. Will inflation come down? Of course it will, because demand destruction is obvious. We're seeing it here. We're seeing it in real estate. Despite what you're hearing, if you're living in the East Coast, if you're living on the West Coast, if you're living in Florida, South Florida, you're not seeing any signs of this. But the rest of the country, real estate is collapsing, and we've discussed that in the past. And I'll go into that in detail this week. But the bottom line is that country by the beginning to middle of next year will be in some type of deep recession, maybe even a depression, based on you know the GDP numbers. You know, 2 consecutive quarters in depression is 4 consecutive quarters. We could be in a depression by 2023. But let's talk about today. Inflation expectations higher than expected. Why would you sell off stocks if you were buying them yesterday? It makes no sense. The market is illiquid, completely illiquid. If you look at the volumes, and it's easy to manipulate. So pre-market is even more illiquid than what's going on in the regular session. So don't even pay attention to pre-market movements. They're ridiculous. But specifically talking about certain things that will bring inflation down, you look at gas prices. So gasoline prices have come down quite a bit across the country. That is something that is being manipulated, and certainly that is going to cause inflation to come down at some point, probably September, October. I want to mention this because there's a big problem here with gasoline prices. Not the fact that they're coming down, but why they're coming down. There has been demand destruction in the summertime because prices were too high, but they're coming down pretty rapidly, mainly because the U.S. government has been depleting the strategic oil reserve. We have never seen this before. It is absolutely a disgrace. It's if you look at the idea of the strategic oil reserve is to make sure that we have enough oil just in case in times of war or other crisis. The White House decided late spring, early summer, they were going to bring down gasoline prices because they needed definitely desperately to bring down inflation and also obviously to help them at the polls in November. So if you look at what they've done to the strategic oil reserve, I mean, it's no longer strategic oil reserve. If there was a crisis, if there was some kind of crazy, outlandish thing that happened around the world, like a world war, some of the nature, the United States would be completely screwed because we have no oil reserves now. So our domestic oil production has been squashed. Our strategic oil reserve is depleted, and the gasoline prices are being manipulated lower. How long this will last? Probably for some time because there's still a lot of reserves left. They don't even care. They're going to keep selling oil until prices are wherever they think it should be, meaning the CPI. But we're going to see continued demand destruction through the beginning of next year. So I don't know where oil prices are going to be. Certainly, inflation is going to come down. It is peaking and it is going to come down. But in the short term, obviously, the markets are just going to focus on these little tweaks and they're going to manipulate the prices. But I think the real issue that no one is really paying attention to is the U.S. dollar. The U.S. dollar is ripping higher. The government and the Fed, more importantly, want the dollar to be strong. And the reason they want the dollar to be strong is it's the easiest way, or let's say the historical way of reducing their debt burden. Okay, the U.S. government, in technical terms, has the highest debt ratio it's ever had. If you factor in the where the debt is, for example, how much of the debt is short term versus long term, the U.S. government's in serious trouble here because if they allowed rates, which they're not going to, if they allowed rates on their shorter term debt to rise significantly higher and they were to market, the U.S. government would technically be most likely be bankrupt in terms of cash flow, right? I mean, in terms of amount of taxes coming in versus cash coming out. And when those bonds, when those short-term debt bonds that were taken out when rates were almost zero, they're going to mature in a year or two. They're going to mature sometime at the end of this year and big time in 2023. And if rates are at where they are today, and they continue to go higher, which Powell said they will go higher, at least in the short term, we're going to have serious problems. And so today's dollar issue, which is causing major problems, and we're going to see it in tech earnings, right? The tech companies do a lot of business overseas. So if they're doing business in a weakening yen or a weakening euro, it's going to hurt their earnings. So be prepared for big earnings depletions coming from any companies that do business overseas, which means all of the car companies, tech companies, etc. But I want to focus on three things in the short term for the US dollar: gold, emerging markets, and crypto. So with gold, I've never been a bull with gold in the past, but I've been very bullish gold the last 18 months to 2 years. I continue to be bullish gold, but in the short term, with this US dollar being manipulated higher, gold is going to have to find another level. It's trying to hold this current level, but I think realistically, gold's going to get hit at some point and try to test this 1400 level, and that's going to be an amazing buying opportunity. I wouldn't be buying gold here. I wouldn't sell it, but certainly I'd look for a flush around the 1500 level to be a buyer. Emerging markets, which I think are going to be a big beneficiary over the next 5 to 7 years, are going to be in the short term hurt by this manipulative dollar rise. So no matter what country you're investing in, whether it's China, Brazil, etc., you need to be careful over the next 3 or 4 months. But it's going to create a buying opportunity. So what I'm trying to say is the U.S. dollar being manipulated higher by the Fed and the government is going to create amazing buying opportunities in not only gold but emerging markets. And emerging markets stock prices are historically where you really want to load up, and that time is coming. And the final thing is crypto. So crypto still is by some people considered sort of digital gold. It has been following the stock price. It really shouldn't. Really, at the end of the day, you really got to focus on the only thing that matters, which is Bitcoin. I think the destruction of the cryptocurrencies is good for Bitcoin, and at some point we're going to see a split between the Bitcoin price and the rest of crypto. And I think we've already begun to see that, but it's going to really, I think, before the end of the year, create an amazing opportunity to buy a Bitcoin. Remember, Bitcoin is only 21 million. If it becomes a digital gold, which I think that's more than a currency, it's going to become digital gold. It's going to be worth significantly higher if you do the numbers. I've done the numbers, and in some future video, I'll go through the numbers. But certainly Bitcoin, not the other crypto, Bitcoin is going to be a very interesting purchase when there is a flush, and there's going to be another flush. So let's talk about the Fed, which is really the entity that's creating all these issues. I have no respect for Powell. He's a dove behind in sheep's clothing. He's manipulated by his friends at the Carlyle Group. I don't think he really wants to raise rates, but I think he feels he must keep his legacy, and that's all he cares about. He doesn't care about you, doesn't care about me, doesn't care about the inflation, because here's a guy who grew up person of privilege, wouldn't know what a can of Coke costs, wouldn't know what a steak costs other than in Sparks Restaurant in New York. He's there, and he's going to take these rates higher. He's going to push this economy into deep recession, because it already is in recession, and there's nothing anyone can do. But at some point, when his buddies at Carlyle say it's time, he's going to reverse. That's when the dollar will reverse, And that's when you're going to see amazing opportunities, not in the US stock market, but outside the US in commodities and other things, including crypto. I want to mention one thing that's very interesting here in the US stock market, talking about what should we be buying in the future or in the short term when things weaken, are the large banks, what we used to call the money center banks. These are Citibank, this is JP Morgan, etc. If you look at what they've been doing over this last 2 or 3 years, or even going back to the after the financial crisis, they have just not been lending. Okay, so they're not exposed to the collapsing real estate market. They're not really exposed to what's going to be a collapse in because we're seeing a big pickup in consumers taking up credit. It's not coming from the large banks. All mostly alternative lending. Large banks have been sort of stepping back, being very conservative, really looking at FICO scores, and have not participated in any of this lending. So when we do turn lower, the large banks are going to be in great position to step in and take advantage. So as stock prices go lower, I think the money center banks are going to be a great place to look at. There's been a lot of talk this morning about wages and wage inflation. Wage inflation still hasn't hit the system. It's going to hit the system, and that may be the final sort of movement higher, or the final thing that let's say peaks out with inflation before inflation begins to start going down because of demand destruction. The one area that we're seeing, one area that's sort of a leading indicator is the Wall Street, the investment banks. They're reducing employees, right? They're not raising salaries like all the other retailers. They're reducing employees. They're moving people out of New York. They're moving people to Utah, to Florida, to Texas. And the reason they're doing that is they see what's going on in New York. They see what's going on in the economy, and also the fact that they've been disrupted by technology. So again, looking at investment opportunities, these banks are run by smart people, like the money center banks. They're reducing costs, so when things turn for them, and I don't know when that's going to be, they're going to be in a position to generate a lot of interesting margins again, but at a reduced revenue level. The last thing I want to mention, again, talk about stuff that's happening outside the U.S. There's some really troubling issues which are going to contribute to declining stock markets, and that is, one of them is Canada. Canada is, along with Mexico, our largest trading partner. The Canadian economy is collapsing, led by the real estate market. So they like China, tried this zero COVID, it didn't work. Your real estate prices were manipulated, similar to our real estate prices being manipulated. Their economy has problems, and they have big inflation issues, as we do here. They have bigger inflation issues than we do because their food prices are much higher than ours. So we're seeing now incredible inflation spikes and economic movement slower, led by real estate. Real estate, Canada had a hotter real estate market than the U.S., and it's really collapsing right now. Prices are down 25-30%. And prices haven't even begun to really go down as much as they're going to. So the Canadian economy is having serious issues, and will continue to do so. And again, one of our biggest trading partners, it's a problem. And then finally, Europe. I start hearing about Europe a lot more. Europe is in big trouble. Europe, stagflation is a big issue in Europe. You could see it, for example, in anecdotal evidence. Energy bills in Italy skyrocketing. Italy normally had very low sort of energy costs for individuals. Those prices are up 200-300%. We know what's going on in Germany, but I think the Germans are a little better positioned to hold this, where Italy just does not have the capabilities of helping out consumers. If we look at the CPI in places like Denmark, is probably one of the most well-run countries, well-run economies in all of Europe, maybe even the world. But look at the CPI in Denmark, over 10%. That's a big problem for a very small country. And finally, just overall, the energy burden in the EU is creating huge issues. And obviously, it's inflationary, but more importantly, it's going to hit their economy and drive their economy, which is already in recession, maybe into very, very deep recession. They're already in stagflation. But the interesting part, and I'll finish up here, is the positioning in equities in the U.S. Despite all this volatility, the positioning, right? This is equity positioning among institutions is very bullish, right? It's counter cyclical. So you want to see people give up on the market before the market goes higher. I don't think this is going to point to a rally in the very short term, but when everyone is bearish, you certainly don't want to get in that bearish camp. And this is really more for traders rather than for investors. But equity positioning is very bad right now. People are very negative on the equity markets in the U.S., and that usually leads to, as we saw in July, amazing rallies. So just keep out for that. Happy trading, and we'll speak to you tomorrow.